Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Brian Levitt of Invesco writing, market drawdowns and volatility are almost always the result of policy uncertainty. Investors may need to brace themselves for additional volatility, but I suspect we know this drill. Brian joins us now for more. Brian, good morning. Good to see you.
Good to see you.
Is the peak uncertainty behind us yet?
No, I don't think the peak uncertainty is behind us, although I don't want to be overly negative. I'm just reflecting on coming off of a period where volatility had been quite low. So I think ultimately it'll be a good environment for stocks, but it's going to be a little bit more difficult. We have inflation at the upper end of the comfort zone, which isn't terrible unless the Federal Reserve thinks they may have to take a different approach. And we still have to deal with the uncertainty around trade and industrial policy. So there's more to come on this. Investors probably looked at what happened with Canada and Mexico with regards to the tariffs and said, okay, all good. I suspect that's probably not the case. We'll have some volatility in here, but that doesn't change the fact that it's still a good backdrop for risk assets.
In the meantime, we're just eating into consensus trades to start 2025. In the FX market, the dollar is weaker, not stronger. In the bond market, yields are lower, not higher. And if you're looking at equities on a geographic basis, Europe is outperforming the United States. Do you want to fade that or pile in?
I would pile in. I think the reality is we've had such a prolonged period of U.S. outperformance driven by a handful of names. What we've all been wanting is some broadening out in these markets. Now, just because things like small caps or European stocks were cheap didn't mean that they were going to outperform. You needed some catalysts. And what you have right now is, of course, easing in different parts of the world. You have valuations a little bit more extended in the United States. You have higher nominal growth, improving expectations in Europe. So yeah, it's a better backdrop. You remember that period, we all remember it, 2009 through 2019, where nothing could perform but U.S. growth stocks. We were in a very low nominal growth world. So now we're in a better improving nominal growth environment.
So the story you just told about Europe is not as exciting as the story that other people say, which is this is the beginning of actual spending, of actual stimulus, in addition to a disinflationary trend that can eventually allow ECB rate cuts. Are you basically saying you don't buy some of the optimism that this is really the moment that Europe could join together, issue Euro bonds to support defense stocks, and inject some stimulus in the overall economy?
Well, we've seen this before. So, fool me once, shame on you. Fool me twice, shame on me. Is that how it goes? Right. So I'm not ready to say that this is the moment. The way I look at Europe right now is not good or bad. It's better or worse. And things are getting better than where they were. We had this long environment where things were generally getting worse. The fact that floating rate mortgages exist in a lot of parts of Europe wasn't necessarily helpful. But now we've got this easing environment. Sentiment's picking up. I would look at it more as a cyclical recovery in sentiment and a better policy environment rather than necessarily viewing it right now as a bigger structural story. We need some proof on that.
There are some contradictions in the story. On one hand, if you have growth improving, doesn't that tie the hands of central banks in terms of how much they can cut rates, leaving benchmark borrowing costs at a higher pace, which typically pressures stocks?
Well, different parts of the world have different answers. I think in Europe, in the UK, we're going to need to see interest rates continue to move lower. In the United States, the point I was getting at is I like inflation at the upper end of the comfort zone. People have been wanting weaker, rates to come down. In September, the Fed fund implied future said rates would be below 3% at the end of this year. Well, what would have happened between then and end of 2025 that rates had to be below 3%? That's a bad economic outcome. So the fact that we've reassessed that now, we're not pricing in tightening. We've just backed out the rate cuts, which suggests that this is going to be a pretty good growth environment. Inflation at the upper end of the comfort zone, to me, is a better environment than where we were for a decade, where we couldn't get it into the comfort zone because higher nominal growth accrues to corporate profitability. Now, the risk to all of this is obviously if inflation jumps and the Fed has to tighten, we are clearly not priced for that. That's where equity valuations get hit. That's end of cycle stuff. But I still think inflation's going to moderate. We saw it a bit with the producer price index. Seems like wages are moderating, shelter's moderating. So I don't think it's as big of a concern. CPI, what was that, last Monday? I think that was a bit of an overreaction. The market's recovered from.
But what about tariffs? Could they be a hit to inflation to go above that range you seem to be very comfortable with?
Yeah, I suppose they could be, except it's a little bit of a different environment than 2018. But if you use 2018 as an example, you saw one-off price shocks in products rather than broad-based inflation. And actually, you started to get a hit to sentiment. And that hit to sentiment actually caused markets to start to think about a recession by the fourth quarter. And, most people don't remember is the Fed actually was easing in 2019, not raising rates. Now, it's a different environment because inflation's at the upper end of the comfort zone rather than, in a deflationary environment. But historically, tariffs don't lead to broad-based inflation.
What do you think causes more angst in the market? Is it the actual tariffs, or is it the continued policy uncertainty about tariffs might be coming every single week?
Uncertainty. And that was the story of 2018, was that it was sort of a trade policy by tweet at that time. And each week we got something new, and it was very difficult how to respond to it. And business sentiment really got hit. If you look at capital expenditures back then, in the beginning of the trade war, they were positive year over year. By mid to late 2019, they were negative year over year. So that's the challenge. The risk to this is just a prolonged period of policy uncertainty. Tariffs, I think we could all agree, lead to a less optimal economic outcome, right, almost by definition. But we can deal with that. Businesses just need to know the rules of the game in order to proceed with confidence.
Fed Governor Chris Waller doesn't seem too worried at all. Listening to him speaking over the long weekend, my baseline view is that any imposition of tariffs will only modestly increase prices and in a non-persistent manner. Lisa going on to say, I favour looking through these effects. He's alluded to this before, reiterated it again.
Some people have agreed with him. However, he has been an outlier, as he did seem more hawkish last September, and now seems to have shifted his tune, and some people are talking about maybe he's in contention for Fed chair. That said, other Fed officials have echoed this, both on the record and off the record, saying essentially in the past they have been more of a suppressor of growth than they have been an ignition of inflation.
He's running. I think we've said that before. A lot of people believe that's the case. Brian Levitt on Invesco. Scott Chronert of Citi saying we do characterize ourselves as fundamental optimists, but we also recognize that some important macro tailwinds need to unfold, which would transition us from a no-cycle regime to something more like an early cycle backdrop. Scott joins us now for more. Scott, welcome to the program, sir. I want to pick up on a note that you put out just last week when you said tamer tariff talk. Now, Scott, I want to understand whether you believe the tamer tariff talk is ultimately in the driving seat of what we're seeing take place across stocks, bonds and foreign exchange.
Well, I think we keep going from a threat to let's push things out and step back and better analyze the tariff situation. And that's been ongoing now for the past, several weeks. What I think is important here, though, is that I think the market has been concerned regarding Trump, red wave, and tariffs for several months now, and I think has been preparing for it psychologically, but probably not in an actual positioning angle yet. I think that's still out there, but all told, what's happening is that you have ongoing tariff rhetoric, but at the same time, we're seeing a little bit more movement in terms of cost-cutting initiatives, which are pretty apparent now. And what that does is begin to give you a more balanced effect of the aggregate Trump policy now versus what we were looking at, say, a few months ago.
So translate that into positioning. How much are you seeing essentially less growth from some of the cost cutting versus some of the pro-growth measures that some people were talking about from the Trump administration, and that still needs to get priced into equities?
Well, Lisa, it's a really good question. So I think what we're looking at here, just looking at the S&P for performance, you're up about 4% year to date. Look at where your leadership's coming. First off, where's it not coming from? And it's not coming from tech and consumer discretionary. You're seeing broadening at work under the surface. In fact, the S&P top 50 for the first time in quite a while now are no longer leading the charge for the S&P. So broadening's happening, and I think what this reflects is a couple of things. Ongoing positive sentiment around the underlying economic direction, a little bit less concern about tariffs in their own right now, and what that does do is begin to set up, I think, for a healthier S&P outlook as we go into the balance of the year.
Do you believe, Scott, as we were just talking to Bank of America, Elias Galou about, that the faster inflation today than what we saw in 2017 and 2018 effectively ties the hands of the Trump administration to go really tit for tat into a full-blown trade war?
I think potentially it does. I think it's too soon to make that call, though. I think there's no doubt that when you're looking at tariffs, that part of this bigger program is that you at some point are going to need revenue offsets to the positive to contend with what happens from the deficit math as you go to extend TCJA and potentially lower corporate taxes in other places. All told, Lisa, what's happening here is that you've got a combination of forces that are at work that are going to need to be addressed. Inflation is going to, at some level, be a little bit of a hand tire to how aggressive you get potentially with tariffs. But our view with tariffs is for a while now has been it's less about the concern with inflation, more about the concern with gross margins and other supply chain disruptions. So there's still, in our view, a moving conversation around where the inflation dynamic fits in here. We're comfortable with the current backdrop right now. We're comfortable with Fed funds and the expectations for a cut or two this year. We're comfortable with 10 years hovering in this 450 range.
Scott, how do you start pricing in some of the retaliation, though, we can see from other countries if those tariffs that Trump has talked about, which besides China, we haven't seen them yet, but if the ones he's talked about actually come into effect?
Well, I think we're going to have to get there. I think that's an ongoing concern. Again, all told, we have to expect tariffs. You have to expect retaliatory actions by countries affected. But importantly, when we're looking at the aggregate tariff setup, be careful here. When you're looking at a tariff on Canada, Mexico, a more specific country-related tariff, that probably is a negotiating tool towards accomplishing some other purpose. When you go down the path of, say, 10% across the board, that maybe gets dialed back to some more a balanced number, say 5% or so. What ends up happening, though, is the importance of that is, number one, in our view, how it fits into the revenue generation deficit math. The retaliatory part comes into play, but here's where you also have to begin to factor in the fact that a strengthening dollar over the past couple of months may at some level begin to price some of this in. So all told, we're certainly not immune to the issue. We are at the margin still quite concerned about it, but just trying to make the point here that identifying tariffs alone as an issue, I think probably is the wrong way to look at this. The right way is that it's part of a bigger Trump package that's working its way through the system and through Congress right now and through the markets. And I think what the market is telling you is that it's pretty comfortable, all told, with the balance that we're seeing between tariffs, potential tax reform, and then what's happening on the cost reduction front.
Well, Scott, key word there is potential. It might take months to see those tax cuts get on board when it comes to the House and the Senate in Congress. How is it important for the markets to be able to have both at the same time, the tariffs, but also the tax cuts?
Yeah, I mean, it's a good question because tariffs presumably can hit sooner. Okay, so they get modeled in terms of our 25 expectations. Tax reform probably is a 26 issue. Again, for several months now, we've said Trump red sweep. An issue we have is that you need to see some focus on the spending side because that deficit math continues to linger as an issue for this year. We've been talking about the bond market vigilantes perhaps coming back into the picture. We haven't seen that right yet. But I think the key point here is that the market is beginning to price forward fairly aggressively where we think underlying earnings expectations go. That's a bigger issue for us right now, Anne-Marie, than are the tariffs themselves. Our concern is that the market is already pricing in fairly heady earnings growth presumptions for the next several years. That, in our minds, is not necessarily negative, but what it does do is put a really big focus on earnings growth to continue to deliver as we go into 25, 26, and beyond. So by no means is this a coast-to-coast is clear environment. There are still many hurdles that we're going to have to be navigating. So I think a big message for us is expect volatility. It's going to be a persistent feature of this market. And at this point, we want to be conditioned to be buyers into said volatility.
Hey, Scott, appreciate your views, sir. Scott Chronert there at Citi. Eco data and Fed speak on deck after recent inflation and retail sales prints whipsawed traders through the last week. Nela Richardson of ADP writing, consumer strength is due in large part to the solid job market. Cracks are forming beneath the surface and threaten to spill over to the consumer. Nela joins us now for more. Nela, good morning. It's good to see you as always. Let's start with those cracks. Where are they?
Well, they're really in the good sector, but bigger picture, bigger level here. The consumer and the worker have been aligned. They've been in lockstep. The consumer's done well, the labor market's done well, and vice versa. Consumers are driving the labor market hiring. If you look at where the industries are taking off, it's in healthcare and leisure and hospitality. These are consumer-oriented, consumer-facing industries. So yes, there's cracks. We saw them last week with the retail spending. If the consumer starts to falter, what does that mean for hiring in the labor market? That's what I'm watching.
So that particular sector, the experiences sector, for you will be the tell that this is truly a labor market that's turning over. Is that correct?
It is one of the tells. Because when I also look at what else is happening in the labor market, business services aren't performing the way they did in the first half of 2024. We've seen a sluggishness in professional business services. So what carries the torch for this market if the consumer's under pressure, if the consumer feels the pinch, there's nothing to take up the slack. And that's the issue. It's not goods, it's not manufacturing, it's not professional services. There's nothing left.
It's not tech, and we're seeing those tech layoffs consistently announced across the board. We were just talking about Southwest announcing their first round of involuntary layoffs in their 50-year history. Are these headlines just one-offs, or is this growing to become a trend that you're watching in terms of efficiencies and that turning to job cuts in a way that it hadn't over the past couple of years?
You know, I've consistently said, and it's true, that the labor market is solid. You're seeing solid overall growth. It's the cracks beneath the surface that we're watching. For example, new hires. We tend to match at ADP individuals, but sometimes it's great to just look at the cohort of crops of new hires this year versus last. There's been no pay growth in this crop. Why? Well, companies are hiring less tenured, less skilled workers now than they did last year. Is that a signal of a trend that more highly skilled workers are not as in demand as they were a year before? That's definitely something we're watching, and we see that across industries, especially in financial services and information. These are typically highly skilled industries.
Nela, your research says that 60% of U.S. workers live paycheck to paycheck.
That's right.
Last week, we found out inflation is still quite hot. At what point do you see these workers, these consumers, pushing back?
Exactly. We've been waiting for this. We've been waiting for consumer resilience to turn to consumer reluctance because of higher inflation. It has not happened except last week. We saw the beginning of that. Now, it could just be a cold weather month, but the broad-based slowdown in retail sales suggests to me that it was more than just a really cold January. Something else could be afoot. And it could be that these higher price levels are starting finally to make a dent. We won't know until we get a little bit more data on that, though.
You said that the prices or the wages that people are earning when they come in are the same for the incoming class this year as they are last year. How much could that be due to the use of certain efficiency tools? And I'm talking about machine learning to offset some of the roles that some of the highly skilled individuals coming in would have to hold. I mean, how messy is this data because of these bigger trends that are forming the labor market?
You know, when you think about where the slowdown is happening in business services, those entry-level jobs are increasingly those that can be automated. This is new for the knowledge worker skill base. And so that trend is something that could have a through line from cyclical to structural. And that's what's really hard about the labor market now with all these technological advances and the demographic changes. We don't know how much of this is sticking and how much of this is just, because interest rates are higher than we'd like them to be, and that's weighing in on hiring decisions.
Earlier in the show, we were talking about the fund manager survey out of Bank of America, and right now the lowest number of people are expecting some sort of recession in at least 3 years. Mm-hmm. Based on your observations in the cracks, do you think that that's miscast or that it should be a higher percentage?
It's recession to me, those expectations is like the rain. Unless you tell me the time and the location, it's meaningless because recessions happen, on a pretty, regular heartbeat. When you look at history, this last economic expansion was way longer than historical norms. But I don't think there's anything that suggests right now with a 4% unemployment rate that we're heading to recession. But there could be some slowdown in hiring. There's uncertainty in policy that would cause employers maybe to take a step back, not hire as robustly, not hire as aggressively as they had in previous years.
We'll see if any of this shows up in jobless claims on Thursday, particularly the government layoffs we're all focused on at the moment. Nela, it's good to see you as always. Thank you. Nela Richardson there of ADP. We begin this hour with US stocks inching higher. Kevin Gordon and Charles Scwhab with this to say. One of the hallmarks of the US stock market's run last year was minimal scouring at the index level. That is unlikely to continue this year. Kevin joins us now for more. Kevin, that's a conversation we've had a few times with you. Beneath the surface, though, we're starting to see some real dispersion take place. You wrote in just last week about some of that dispersion within tech. We noted the moves we've seen in Meta. You pointed out the moves we've seen in Tesla. What makes sense from your perspective as to why that's happening?
Well, I think that, within some of the themes for a group like the Mag 7, if you're going to look at it on a sector basis, there's three sectors that are represented there. It's consumer discretionary, it's communication services, it's tech. And one of the things we've really been pounding the table on in the past couple of years is not looking at that group as a monolith. And I think a lot of that is starting to show, you could kind of date it back to last summer when there were a lot more CapEx concerns when we got to earnings season in the late summer period. But now, from a trade war standpoint and what the exposure is from a geopolitical perspective, there is probably a lot more being priced in there, being reflected in the price there. Because if you look at even the split between consumer discretionary and tech versus communication services, to your point about the likes of Meta doing well versus the likes of Tesla, or even, some of the hardware names, whether it's NVIDIA, whether it's Apple, in the tech space, not doing as well. Some of that is maybe reflective of the exposure to China, the exposure to the rest of the world, and what a potential tariff war, trade war could mean for those companies.
How do you expect this to show up at the index level? This is all beneath the surface. How do you expect to see this at the index level?
To some extent, you're seeing it where, even if you look over the past couple of months, the S&P 500 hasn't really moved much. It's been this really tough kind of grind higher, at times a grind higher, mostly a grind sideways. But there have been other sectors that have really been leading the charge and picking up the slack. Financials has kind of been the standout there. So I think that from an index standpoint, you may not see as much excitement this year, but at the individual stock level or maybe at the individual industry level, you could see a lot more excitement. So it's kind of, to the quote you pulled at the beginning of the segment, our theme around maybe not as much excitement as you saw last year, because at the index level last year was great. Max drawdown 8.5%, but the average drawdown at the member level much worse, 21%. Maybe that gets flipped this year. Not that we expect some imminent 21% correction for the index, but there's just more of a churn kind of at the index level if there's not as much participation from some of the mega caps.
If this churn is sort of continued, I wonder how much that's the reason for this split that we're seeing in surveys, where you have AIII coming out with the greatest degree of pessimism among retail investors going back 3 years, at the same time that institutional investors have the greatest degree of optimism in years. And you've got the lowest rates of cash going back to 2010. How do you put these two things together with some sort of conclusion?
Well, this has become for us kind of a post-pandemic phenomenon, especially when we talk to our investors and our clients, which it's a great deal of people. It's more than 40 million people. So we have a pretty good gauge of what sentiment is like, both on the attitudinal but also on the positioning side of things. But what we've seen post-pandemic is that attitudinal, those attitudinal metrics are sometimes much more skittish and much more jumpy, and they don't necessarily reflect what's going on in positioning. So you talk about those two headlines kind of side by side. Yes, a huge pickup in bearishness for something like AAII, but not reflected in equity positioning at all. To us, the attitudinal stuff probably becomes more of a useful shorter-term gauge as to when you get a washout in sentiment and when the market can kind of pick up and get back on its feet, over the past several weeks, which we've seen. From a behavioral standpoint, it kind of shows you that over the long term, we're still in pretty frothy territory. Because you look at the household exposure to equities, for the Fed data that we have going back, almost a century, you're still at near record exposure. The only other time you were at this level was in 2000.
How much are some of the headlines around policy changes affecting retail investors more than institutional investors who are looking through it until they get something concrete?
It's fascinating is for the first time since I can really remember, especially leading up to the election when we were talking to clients and going around and doing events, and I was just speaking to a bunch of clients last week. First event ever where tariffs were not at all a part of the question. All of the questions were about immigration policy. So I think that there is this interesting shift now at play where I think there's more meat getting kind of put on the bones as to what the potential growth hit is from a labor standpoint. And a lot of the focus tends to be or has been on the inflation impact potentially from tariffs, but now it's shifting to what does this mean not only for inflation from a labor standpoint, but also what does this now mean for a potential hit to growth. So it was a really interesting shift where clients are now starting to ask what are those sort of fundamental issues maybe if you go to the extreme end as to what's being proposed for immigration.
What are clients asking when it comes to tax cuts? Do they want to see those tax cuts alongside potentially the hit from immigration and tariffs?
It's a mixed bag. I think tax cuts just kind of at the outset or at a headline level garner a lot of attention and a lot of support generally. I think the tough part about this is that it's the struggle right now in Washington is just to get the extension of the TCJA. So it's really just maintaining the status quo. It's not initiating this new wave of tax cuts. And the other hard part about this, and this is kind of where I struggle and scratch my head a lot from a policy standpoint and what's contradictory coming out of Washington is tariffs and tariff revenue is kind of being poised as this driver of revenue to offset the extension of tax cuts. But then every time the tariffs get either delayed or peeled off, then the market sort of cheers it. But then I'm asking myself, well, where is that supposed revenue coming for the tax cut? So it's a little bit of this vicious circle that's at play where, yes, you could have excitement for something like fiscal policy continuing to be relatively expansionary and accommodative. But at the same time, you also have potential restrictions coming from aggressive tariff policy.
Right. And there's been a lot of bark, not a ton of bite, except for one, the 10% on Chinese imports. You put it in your note, projecting any kind of tariff-related hit to stocks with a degree of precision is impossible. So then what do you project?
Well, for tariffs, you can't, to that point, you can't project anything. Almost from anything policy related, you can't make a projection because it changes every single day. So really,
How much of a hit to the market is just that constant churn of uncertainty?
Oh, I think that's where a lot of the hit resides. And, I think that this is a lot of the focus, maybe rightly so, gets put on the actual policy. What's the dollar amount for the tariffs? Who gets hit? When does it happen? How is it phased in over time? I think that's important, but I think it also misses the point of the nature of this policymaking is what creates this, and I think I mentioned it last time I was here, this real thick fog of uncertainty, where it's just harder for businesses to operate in that environment.
One thing that's been less than certain is that one of the cost savings is going to be driven by just cutting jobs. I mean, we've seen that pretty much across the board with the efforts of DOGE and reports about thousands of government workers being laid off. Do you see that being factored into any market valuations of companies that have contracts with governments, with the government, or any other kind of employer base that might be looking at this and taking its cues?
It's early days, I think, to see the federal hit, especially if you're going to just look at the overall labor market. The share of the workforce for federal workers is quite small. You're in low single digits. To me, and I think what is becoming a more material risk it's not happening right now, but I think what's worth watching in terms of it being a material risk is the eventual hits to state and local, employment. And because that's a much larger share. I mean, you're getting into double digits in terms of the percentage of the workforce. So you talk about, number one, a big driver of job growth over the past several years, but number two, just a big part of the total labor force in the country. If there is that connection and that eventual follow through from what's going on at the federal level, then I think you get to a little bit more of a worrisome situation. Fortunately, it's not something that's happening, right now and imminently, but a lot of this is moving really quickly. So you do have the potential of seeing that show up maybe relatively soon in a jobs report.
Speaking of moving quickly, can we finish on Europe? 6 weeks of gains on the Euro Stoxx 50.
Yeah.
You talked about your clients. Are your clients getting interested yet?
I will say it's taken a long time, meaning years, for clients to get kind of fully on board with it. But especially if you're kind of talking about and factoring in some of these risks from a policy standpoint, my colleague on the ex-US side, Jeff Kleintop, talks a lot about the MSCI IFA being more exposed to Japan and the UK. To the extent you want to look at those areas of the world that are maybe less exposed to a trade or a tariff risk from the US side of things, maybe there is a little bit more of a benefit there. So we've been very vocal about kind of balancing things there, not just, back up the truck, dump everything US and then load up on, ex-US. But it has taken, to your point, it's taken a long time for clients to kind of, I would say latch on to that.
It's still early days. Let's see if it works out. But so far in 2025, up double digits on the Euro Stoxx 50. Kevin Golden there at Charles Scwhab. Kevin, always good to see you.
Thanks.
Appreciate it. Thank you. More headlines coming from that meeting taking place in Riyadh, Saudi Arabia.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.